AmBev is a subsidiary of AB InBev, the world's largest brewing company. And AmBev manufactures and sells global beer brands like Budweiser, Corona, as well as more local brands like Brahma. Its operation covers all of Americas except the United States, and the four main regions are the following. Brazil is the largest region with about $8 billion of revenue, which is about 58% of total revenue. Next, CAC region is the Central America and the Caribbean, which includes Cuba, Panama, and Dominican Republic. CAC generates about $1.5 billion of revenue per year, which is about 12% of the total. LAS region is Latin America South, which includes Argentina, Bolivia, Chile, and more. LAS generates about $2.3 billion, or about 17% of total. Lastly, Canada generates about $1.6 billion, or 12% of the total revenue. Despite its prominence in these countries, AmBev stock price fell by 30% in the last 12 months, or more than 50% fall since the pandemic. And not only the stock price fell, but this EV/EBITDA multiple trend shows that AmBev is currently the cheapest it has been over the decade. So today, we will conduct a full financial analysis and finish with a summary of the bullish and bearish points. First of all, AmBev's 15-year average ROE is 25.9%, indicating a high business quality. But of course, the problem is that this ROE level came down in recent years. Let's look at the DuPont analysis to see the cause of declining ROE. As we can see here, financial leverage fell slightly, and the asset turnover improved about 10% from 10 years ago. But the most impactful was the fall of net profit margin in yellow, from above 30% 10 years ago to only about 17 to 18% in recent years. AmBev's revenue in blue bar fluctuated over the years, but over the 10 plus year period, it's remaining at a similar level. But the GP and EBIT margin both fell throughout the time, and this margin erosion is also evident if we look at this EBITDA trend. One of the important advantages of investing in an established consumer brand company like AmBev is that its free cash flow conversion is very good. And as we can see here, the free cash flow in green is very stable and higher than the net income number in purple. This is mainly because the reinvestment need is small, and the company can just replace its D&A with small capex. And such a good cash flow resulted in high dividend payout ratio, which is above 80% in the past 10 years. And the combination of this dividend and falling stock price over the years, its current dividend yield is about 6%. But we need to keep in mind that the dividend is usually paid out just once a year, and because of currency, the DPS can fluctuate a lot in US dollar terms. But usually, the most common challenges for such dividend stock is high leverage. But AmBev is completely free from this risk because it has maintained its net cash position for more than 10 years. You might think that having some level of debt may be beneficial to lower the cost of capital, and that is true. But AmBev has net cash position because its parent company AB InBev, which owns about 2/3 of this company, has about 4 times debt to EBITDA ratio already. So if we step back and look at the big picture here, for AB InBev's management, this operating subsidiary generates cash that the parent can use to pay down its debt. And as a minority shareholder, we can own a piece of this cash generator without any leverage risk. But before we end this in a happy note, we need to revisit its biggest risk, which is stagnant revenue and EBITDA in recent years. If we divide the revenue by each region, here we can see that Brazil and Latin America South, the purple and yellow bars, are the main cause of disappointing revenue trend. One reason is, even though the sales volume of beer actually increased over the years, the difficult local economies made it hard for AmBev to increase price. So even though the overall revenue held it together, the profit level sank more prominently. And this falling profit can also be broken down by regions. And again, Brazil and Latin America South fall in EBITDA are very evident. But outside of these regions, Canada was more stable, and Central America region in green bars even showed good growth in EBITDA over the decade. On top of the weak Brazil economies, this fall of Brazilian real compared to the US dollar over the decade also contributed to lower EBITDA. Because even though revenue is generated in weakening local currency, AmBev has to purchase raw materials in strengthening US dollar. Also, the direct increase in raw material costs like aluminum over the decade also hurt AmBev's profitability. In this last section, we will review some of the major bullish and bearish points on AmBev. In general, beer business with popular brands that reach economies of scale is considered a good business. In AmBev's case, we can see this in this high ROE graph, despite operationally challenging years recently. That's why AmBev was actually created through a merger led by 3G Capital, a very successful Brazilian private equity, and Jim Collins wrote a very good case study book on it called Dream Big. I recommend you to read this book if you are interested in private equity. But the first bearish point actually challenges this, with the rise of competition from craft beers and non-alcoholic beers. Although the jury is still out there on how much of a serious challenge these pose on traditional beer powerhouses like AmBev, and how well can it respond to these threats. But such changes are not a good thing for existing winners. And as an extension, bears would focus on this falling EBITDA trend and recent stagnation. Also, Brazil, which has the largest pie, currently has a chaotic political and macroeconomic environment. So there is also no clear reason for this EBITDA to rise in near future. However, to this, Bull would claim that current 6 times EBITDA multiple is very low, not just in historical context, but also considering that AmBev has a net cash position. So basically, AmBev doesn't even need to grow its EBITDA for shareholders to make good return at its current price. And finally, Bulls would claim that shareholder return will be accelerated because management is taking advantage of its low price by executing share buybacks. These buybacks are increasing in size as the stock price falls more, which is great for long-term shareholders. Okay, so this sums up today's analysis, and if there's anything fundamentally important on AmBev that I missed, please let me know in the comments below. And thanks for watching today, and I will see you in the next value stock analysis.